Whether you're a first-time investor or whether you're a savvy investor, buying your first home is very easily. You can go to the bank and get the mortgage.
No, most definitely.
Right?
Hey guys, welcome back to the channel here. Today we have a special guest and I'm going to be talking about everything to do with the mortgage side of it. And we'll cover a lot to do with first-time home buyers, sellers, and some investors. But before we get into it, I just wanted to say why I chose Chris to do this mortgaging here today, because Chris typically works with all my clients. Some of you have already seen him before and you've already worked with us before. But the reason I wanted to do this is because of the really detailed information and how we always work and how Chris works with every client. A lot of times I'll make sure that everybody goes through him first before we get to move forward with any client per se. We're going to go into details about that as well. So for you guys, just sit back, watch all this. You'll have a lot of questions with this, and you can just write a comment down below, and we'll be able to get back to you on a lot of things here.
If it's a first-time home buyer and they want to get into that entry-level home, let's say it's $600,000-$700,000, we know that at some point they can either sell this property, and we work this all out for the buyer. Okay, we look at the buyer and say, well, what is your goal? Where do you see yourself in the next 3 to 5 years? And do you have kids? Do you not have kids? Are you married? Are you not married? All of the things. But once they get into that property, we know that in 3 years it's going to be worth X. The point I'm trying to make is, what do they do within that time frame? Or if the value of that property that they bought has gone up by $200,000, for example, and they've put 10% down, well, now maybe we can take that allotment of funds, dump it on the new property. Your monthly payments on your mortgage will be lower. But now you're putting more than 20% down. So the difference of that 20% is now where we would borrow that money back at time of closing. We would package it all at once. Where now as you pay down the mortgage, that line of credit will start to increase. As it increases along the way, as you pay down the mortgage, the line of credit increases. As that happens, now we know that we've got this line of credit that we could potentially use towards purchasing another property. Now, what most people will try to do is they want to keep the property, the first home, refinance the property, purchase the second property, right? And turn the existing one into a rental. But some people can't do that. But the good thing is when we go through this exercise, you already know what you're going to be able to afford to buy.
We typically are with you throughout the whole step.
But it gives you part of that plan, indicates what it is that you're able to buy if your property appreciated by 5%, right? Your mortgage balance would be X in 3 years. Once that's paid down and we know how much profit we have, which is the equity, do we buy another property and hold on to this one? Or do we sell this property, purchase another property, a bigger home? Use the equity from that home to go purchase the rental property. So it's just a matter of when you do it and what works best. The earlier you do it, the better, because now you can prepare yourself, you can plan yourself for all the things that you need to do along the way. So if I need you to come up with more money, or if I need you to, see if parents can help you come on board as a co-signer, or, maybe you need to, you're on contract or you're on a probationary period, then we'll time everything around when they actually buy. But the earlier you get into our wheelhouse to figure out what it is that you can qualify for, we don't worry about whether you're buying next month or in 6 months or within the year or in the next year. It doesn't matter. Along the way, if you haven't purchased and interest rates have changed, then we'll go back and we'll look at the interest rate adjustment changes and how does that positively, negatively affect that borrower. So as interest rates come down, it'll increase the client's borrowing power.
And you're able, guys, I've dealt with clients who have not purchased. Some of you are watching this, who did not purchase after a year. Some of them even took 2 years before they ended up buying, and we already had the initial conversation with them and really broke it down like they were about to buy it tomorrow. So I know this is very important to really have that good gauge, good understanding, and really break it down. Like right now, we're dealing with a client who we've had a lot of conversations. Anaki, I hope you're watching, and and we've had a bunch of Zoom calls as well, and there's a lot of understanding that needs to go into one. You're having this phone call with them and they think everything is good. Then all of a sudden we're about to put in an offer and there's just some uncertainty a little bit. And that's when we say, you know what, let's get on Zoom and let's look at the numbers again. And we do that, Chris, myself, and the clients, and we break it down. Chris shows them a bunch of different options. And from there, they're now clear. Okay, this is the maximum price that we're able to purchase. And now let's go ahead and look at it again. And I always try to create this environment for clients where you feel like you can ask whatever questions that you want. If you feel like this is just too much pressure, you don't know what's going on, let's get on Zoom. Let's really break it down for yourself, and let's see where the uncomfort is. Maybe you just don't have the money and you don't want to say it, and that's absolutely okay. It just means let's wait a little bit longer, and maybe it might come up in 6 months.
Well, to your point, like a lot of people will come to me and say, well, we're going to wait till the interest rates come down.
Yeah.
Right?
Yeah.
My response is, but why? Like,
Yeah.
why do you say that? Right?
Yeah.
And majority of people will say, well, the interest rate is lower.
Yeah.
And agreed, the interest rate is lower. But when you do the math, the interest rate is lower. But what happens when the interest rates go down?
That's right. Yeah.
The value of the home goes up.
The home goes up, and
Right? So
yes, you start getting biddings and like
bidding war, sure.
wars, competition in the same kind of property you're looking at. Because the house that you like, trust me, in a hot market, you're not the only one who likes it.
Right.
There's 3, 4, 5 other people who like it. But
So my point is that you can buy in today's market where the interest rates are higher.
yeah,
The property values are lower. So when the values start to go up and the interest rates start to come down, buying in today's market helps you build equity a lot faster.
yeah,
When you're buying when the interest rates are low, you're buying at its peak. Okay?
yeah,
But guess what? When you do all of this, when you work out all the numbers, your payment on the lower rate and the higher purchase price versus the higher rate and the lower purchase price is maybe $100 difference. So you tell us when's the right time to buy. And you know now that your payment will still be the same. It's just a matter of when do you want to get into the market.
I always say this. It's very important to look at the monthly payment as opposed to just the purchase price. Try and combine the two and look at what can you do on a monthly point that influences the purchase price that you can able to do. And once you're doing the qualifications, once you see your income, once you see the down payment that you have and what you can actually qualify for, then from there, because, hey, the client that we're dealing with, they could easily buy a $2.3, $2.4 million home. But when you show them the monthly payment that they have to deal with, they're like, this is a little bit too much because you're approved, your income is good.
Yeah.
You have the down payment. But if you add in the property tax in there, it becomes a little bit much. Now you're leaving just to pay your mortgage, and you're living on a paycheck to paycheck. A lot of that is what has happened a lot this year. Now, what you want to do is see what's your most comfort level of what you can pay on a monthly basis. If $5,000 is what you can do, then at least you have an extra $3,000 from your monthly income. Then let's keep it at that and let that influence the purchasing price. Don't you think?
Yeah, absolutely.
Right.
Absolutely.
So let's look at this example, Chris.
Yeah.
Okay, let's look at it.
Somebody that's looking to buy something for $800,000. Now, I'm going to use, for the ease of understanding, I'm going to use 20%, which is $160K. So from that 160, the mortgage amount that they're going to be funded on would be $640K. So let's just say that they've bought this property, you bought a property in Toronto, it's $800,000. In Toronto, we'll take an approximate 5% appreciation for year over year.
Yeah.
Right, so on that $800,000, you're looking at $40,000 a year. In 3 years, you're at $120K. I'm just doing a 3-year mortgage. Now, if the property appreciated by $120,000, your new value of that property is $920. So now, from this $920,000, I'm going to use the mortgage amount. Now, keep in mind, in 3 years, this mortgage balance would have gone down from 640 to whatever, 630, for example. But let's just use the 640, okay, just to be conservative. So now if you take 920 and you go to 80%, so 736,000, so you can borrow up to 80% of the new value of the property. So 736,000 is what you can borrow up to from the 920.
Yeah.
Right, because we have 20% that's staying in the property. This is the money that you have up to what you have access to. You have access to a $736,000.
Yeah. So you're not going to get the whole $730,000.
Right. The reason why you're not going to get this full $736 is because we still have to subtract the balance of the mortgage, which is $640K. So now you have access to $96,000.
Yeah.
In 3 years.
Okay.
Now remember, on $800,000, we put down $160K.
Okay.
in 3 years, we know that there's almost 100K that's coming back, or that we have access to.
Okay.
Okay?
Yeah.
So now, what do we do with this $96,000?
That's the biggest question now.
Right? So
Go buy
when we
a new
plan,
car or something?
no, I hope not. Maybe once they have enough rental properties,
Yeah.
then they can use the cash flow to contribute towards that car.
That's actually
The
true.
payment
Or
of
you
the
can
car.
actually take it put it towards your kids or
School,
college fund and
college
all that.
fund.
Yeah. So this is how we create that portfolio.
Renovations of the property.
Okay.
But the goal really is to try and pull out the money to either pay yourself back,
Okay.
right, or purchase another property with it.
So let's look at it. So 96,000. So how, for this example, what are we using 96,000 for?
I'm going to use it towards purchasing another home.
Okay.
Okay, because we're now in our first home. We want to be able to buy a second home.
So this is how you end up getting a second home.
But keep in mind, along the way, this is $96,000 within 3 years.
Yeah.
At $100,000 down payment at 20%, you're going to get a $500,000 property. So there's a little bit of work involved when it comes to making sure that you're budgeting and you're saving along the way to ensure that if you can save, let's say you do another $10,000 a year.
Yeah.
So call it, or even $12,000. So let's say $1,000 a month.
Yeah.
If someone can save for the year, for 3 years,
Yeah.
we're now at $36,000.
Okay.
Right? So that 36 on top of the 96 will help out with the closing costs. It'll help you increase your borrowing power. Instead of buying something for 500, you can buy something for 600 instead.
Yeah.
And then we use rental income to offset how you can qualify to purchase this next property.
Right now, as a buyer, if you're buying as an investor, if you buy a condo right now, because that's where the market has really dropped significantly. If you're doing it as an investment, obviously you have to understand if you're buying a condo today, if your plan is not to keep that condo for minimum 3 years, just don't even bother because the condo market is very slow in terms of appreciation today. Well, and I will say for 96,000, that's probably the best bracket of where you're going to get in.
Yeah. And
what you can buy in terms of purchase price.
Yeah. The second property there's pre-construction and there's resale.
There you go. Yeah.
Okay. So it's now we fine tune it and we narrow down and say, well, what property are you buying? Is it a pre-con or a resale?
Yeah.
In my opinion, I always say buy a resale property first.
Yeah.
Right. And then you can do similar to what we've pulled out on your principal residence. We can do similarly to the rental property when you've purchased it. Yeah. And then you can take that money and go buy a pre-construction property because you can let that money sit and make its money along the way. But a lot of times what people do is they'll buy the pre-construction property first and then their hands get tied and their money's tied and they can go purchase another resale home along the way. Right. So I always say try and get one and use that as your, a lot of people use the word piggy bank.
So this is really how investors come into the market.
Yeah, it's a 101 of how an investor can get started. But there's multiple variables that we have to factor in and take into consideration. The top two, I'm going to say, is your risk tolerance.
Yeah.
And do you have a contingency plan? So do you have funds for repairs and vacancies? Have you kept 3 months is the rule that I like to use. If you have 3 months of your rental income set aside, that'll help you along the way in the event that what happened in the market today has happened.
Yeah.
Tenants lose their job.
Yeah.
Your property is vacant.
That's right.
You have the funds to do it.
Yeah.
Right? Otherwise, I'm going to tell you it's probably not the best time for you to do this.
Yeah.
Maybe we wait till next year.
That's right. A lot of this, and this is something a lot of my clients who are watching this already notice. I've dealt with you purchasing your first home as an investor. Typically, what we do in our team is we manage the property for you for the first 2 years. And we'll get the tenant for you. Once the tenant is in there, the tenant will be paying you. And if there's any issues with it, so you just let us know and we go through the whole process with you. And we kind of give you the good flow on how to manage that as well.
Yeah. Well, look, Clement, what's happening in today's market for a lot of investors is they're shying away from purchasing in today's market because they're not cash flow. And 9 out of 10 times people are saying to me, well, if it doesn't cash flow, then I don't want to buy. And then 9 out of 10 times I say, well, if you're expecting it to cash flow, then you shouldn't buy.
Yeah.
Because it's not going to happen all the time. Yeah. For example, people who bought 5 years ago, their interest rates were very low.
Yeah.
So now they're coming up to renewal where they would like to refinance. The value may not have gone up as much as it should have.
Yeah.
But the interest rates have.
That's right.
So now they were positively cash flowing $300 a month, but now with this new interest rate change, they're going to negatively cash flow this $300 a month, right? But along the way, as interest rates come down, you'll see that sliding scale start to happen. But that sliding scale happens throughout the longevity of the property. So this is not let me do this and make money right away. This is 10, 15, 20 years out.
This is a long-term play. Toronto is really not the best market to buy to flip. To buy and sell within 3 months. A lot of times that's really not going to work because you're not going to get the immediate appreciation for it. When you're buying, I always just say, if you're looking at it from an investment perspective, 3 years, 5 years is where you're looking to get a really good appreciation, because the good thing about Toronto is the trend line, the projection typically has always gone up no matter what is going on in the market. So if you're a buyer, you really want to get into understanding what's going on today and be among the first people who are out there at the moment. Thank you for taking the time to listen to all of it. Chris and myself here. Chris, thank you for coming in.
Thank you for having me. I appreciate it.
So that's it, guys. See you in the next one.
Thank you.
Bye.